welcome to the programme. Well, first up tonight, our focus is on property and in particular how measures announced today by the central bank could make it very, very difficult for first-time buyers to get onto the property ladder at all. The central bank would say it's just trying to stop another property bubble emerging, but those trying to buy believe that the new measures, such as the requirement to have a 20% deposit, will make it virtually impossible for them to buy a home. That's what we'll be discussing in a moment with our guests and our studio audience. First is this report from Richard Downs.
In the good old, bad old days, you had to save your deposit before even going near the bank or building society, which had strict limits. 2.5 times annual income, the norm. That was before the madness of the Celtic Tiger. Today, the central bank proposed new rules, which looked very much like what we had before. Evidence of a potential bubble in parts of the property sector has been emerging for months now, with some claiming that the banks, like drug addicts unable to resist a fix, were ready to return to their ruinous old ways, the central bank determined to avoid past mistakes.
We don't want to repeat the problems of the past, and so we want to protect the borrowers from overextending themselves, and we want also to protect the lenders from the consequences of irresponsible lending.
The rules will be simple, focusing on how much banks can lend. There's no outright ban on mortgages above the level of 80% of the value of homes, but banks can only lend 15% of their new mortgage lending above that level. There's also no absolute ban on the multiples at which banks can lend. However, they can't lend more than 20% of their new loan value at multiples of more than 3.5 times annual salary. The dreaded area of buy-to-let investments will get even tougher regulation. No more than 10% of new loans can be at over 70% of the value of the property. At this conference in Dublin today, there was a welcome for what the central bank intends to do from some of the most savvy investors who agree that the measures are necessary to save the banks from themselves.
And also the borrowers from themselves, because it's all very well borrowing an excessive multiple of your income when interest rates are almost zero. But what happens when they rise? I think what the bank have done today is to go back to the way things used to be, where people had to save up to buy a house.
And so the Irish mortgage market looks set for change. Couples will be poring over their combined salary multiples, which will make saving for a deposit the new going out.
Richard Downs reporting there. I'm joined here by Ronan Lyons, economist from Trinity, and Carl Dieter from the Irish Mortgage Brokers and Advisors. First of all, though, I'm going to go to my audience and to you. In the front row there, Ray Arunaba. Tell me, you have a personal story that's really going to be affected by today's measures.
Well, I came to Ireland as a student in the Smurfit Business School just a year back. So I did my master's, and then I found myself a job at EY Dublin. So I want to find a place to stay, basically. So I want to buy a house, but the deposit is so high. I mean, it's 20%. So if I want to buy a house of, say, 200,000, so it's be 40,000 euros I have to actually have in my pocket to actually buy it. So it'll take me around about 3 years. So it's becoming more and more difficult for the first-time buyers like me to actually buy a house. And it's also the rent in Dublin is actually going higher and higher. So, you know, like it's getting expensive to actually buy a house or to even rent in Dublin.
Do you think you'd be able to raise 20% of a deposit rate?
So my estimate is it'll take me another 4 years, 3 to 4 years to actually buy a house. So in the meantime, even though the rent rates are high, so I have to save a lot more to buy a house.
Okay, Bob Quinn up there behind you on the left. I know, Bob, you're a certified financial planner, but you're also in the process of buying a home and you're going to be affected by today.
Yeah, Miriam, a couple of weeks ago we put a booking deposit down on a house which has been built down in Naas for €325,000. Now, the announcement from the central bank today is the difference between putting €32,500 a down payment or €65,000 down. Now, that house isn't going to be due for completion until probably February of 2015. So if we're actually going through the mortgage application process and the new rules kick in over the next 3 months, the difference to us is going to be an extra €32,500. Now, whether or not we have that money there, I also run a business down in Ace, a financial planning business, it turns out. Cash flow is very important. The difference between putting that extra 10% in as a down payment is going to lead to about €150 of a difference by way of monthly mortgage repayment. So I kind of question the central bank's logic in this. They're saying that typically the more skin in the game you have, so to speak, the less chance there is that you're going to run into difficulty in the future. Myself and my wife have demonstrated, I suppose, discipline in managing our financial affairs over the last few years. But that difference of €150 per month is going to take an extra €32,500 out of our savings, out of our pockets, when we've got a lot more things to be spending our money on. Now, discipline is a great thing when it comes along to managing your finances. Prudence is certainly a great thing as well. I'm all for the central bank, I suppose, rowing in and encouraging people to be a little bit more prudent in managing their finances. But by coming along on the 7th, 8th of October and saying, by the way, it's coming in 3 months' time, no ifs or buts about it, I think it's a very blunt instrument for something of this nature.
OK, thanks for that, Bob. Rona, when you hear stories like that, it does seem that what the central bank has done today is almost madness, because it's going to stop people like that buying.
Well, you've got to bear in mind why the central bank is doing what it's doing. And I think it's because we're 30% plus into increases in Dublin, where people, and I would be probably I would be first-time buyer in the next couple of years myself, so this would affect me too. It's easy to get caught into thinking, but if I just had a little bit more credit, I'd be able to get the house I want. Because if everybody gets that, nobody's better off. What happened in the decade of 2007 was the average house price went from roughly €100,000 to not far off €400,000. Now, some of the research I've been doing, trying to break that down, if we had had this rule back then, the house price would never have, the average house price would never have got above €200,000. And it's actually quite close to that currently. So pretty much all of the excess, the boom and the bust that we've seen is down to the lack of a down payment constraint. The fact that you were able to get credit very easily. So that's what we're trying to now. I would agree with Bob.
But practically though, 20% is a huge amount of a deposit, particularly all the bills people are paying.
True.
I mean, how will anyone be able to afford that?
But you've got to remember, a mortgage is a weapon of financial destruction in the wrong hands. You are giving people leverage that they will not get for any other type of asset. So you've got to be very careful. And we know that now to our cost, with the hundreds of thousands of people in negative equity and the tens of thousands of people in arrears, that this isn't a theoretical worry. This is a very practical worry. And if we have rapid increases in prices, particularly in Dublin at the moment, we do stand on the verge of another property bubble, and we've got to do everything we can, and this is the simplest and most effective measure to do it. I would agree the transition period does seem to be very fast. 3 months they're going to bring it in. You would have thought they would have had a longer period, but maybe they're getting worried about what they're seeing.
Carl Dieter, this is just regulation by the central bank. If they'd had more of that before, we mightn't have ended up with the big bubble and crash we had.
Yeah, I think it's badly timed and inappropriate, so it's right in keeping with the way that we do financial regulation in this country in general. But, you know, when you see lending where it's at the moment, it's at levels last seen in the early 1970s, back when we used to have, you know, banks closing down for 6 months at a time. We're only at 10% of where the boom lending was. And you're basically going to turn around to people like the folks in the audience and tell them, look, we understand that you want to own a home one day, but you're just going to have to get double the amount that you had. Now, that's fine if you have a rich mum and dad who will go in and bail you out or help you. But for the people that don't, they're facing into rising rents. And I don't think that's necessarily fair. The most important thing, though, is this is being spoken about as if it's a magic bullet that will actually work. And I have some bad news. These rules used to exist, and while these rules existed, we had booms and busts. We had credit cycles, we had property cycles. As a matter of fact, we even had booms and busts before there was ever a mortgage market in this country. So when you look at it in the wider historical context, this is really, I suppose, financial regulators trying to put their stamp on something and get a win that is really, it's for the wrong thing, because the issue isn't tomorrow's credit bubble. The issue is today's shortage of supply. And I think that Ronan even will agree that you can't use what's known as a macroprudential tool to solve a shortage of housing, and that's really where the issue
let's
is.
come back to that. I mean, we were all doing stories a lot about homelessness and not enough social housing. Surely that will put just more pressure on the lower end.
Well, in effect, the central bank can only do the job it's given. It is...
But it will have knock-on effects. It still has to think about that.
So it's saying to the government, you cannot solve the lack of housing by just giving people more credit, and we're not going to allow that to happen. The way you solve a lack of housing is, as Carl says, we need more supply. So once the central bank has done this, it will put the onus very firmly at the door of the government, the Department of Finance, Department of Taoiseach, Department of the Environment, to figure out why is there a lack of supply, particularly in Dublin. Population in Dublin has grown by about 65,000 families.
It'll take them years to build those houses. Meanwhile, we have people like Bob and Ray hoping to buy houses within the next few years. What do they do?
But so are you suggesting that we would give them too much credit now and they would find themselves in negative equity in a couple of years? The fact
that's
for
a bit of
example,
a fake assumption, because it doesn't mean that you're automatically in negative equity. In fact, if you'd taken out a 100% mortgage last year, you'd be in positive equity today. With the way these rules are working, it'll lock out about 2 and 3 first-time buyers. And they're the people who Patrick Hohenhin isn't going to be there to try and help. He'll be sitting up in his office thinking, wow, you know, I saved the country, when in fact you've got real people who are affected by this, and regulators never have to pay the cost of the bad decisions that they make. And that can't be overlooked. This is also about political posturing, because the timing of it, right before the budget, right before there was talk maybe of some kind of mortgage guarantee scheme being done, this is being done directly to hamper that idea. Now, that idea is bad too. But you don't solve one bad idea by making an equal and opposite bad idea.
And also, Ron, I suppose, is it confusing for buyers? Because like a few weeks ago, the government was talking about help to buy schemes. It's like there's no joined up thinking. We have the central bank doing this for its own prudent reasons, and yet we have the government talking about a scheme to help to buy. So what are purchasers meant to think? Who's doing what?
Well, there's nobody at the wheel in terms of housing policy. We do have a Minister for Housing, but he has only a limited remit compared to how important housing is. If you think about health or education, they have a minister, they have a department, and they have a vote at cabinet. We have nothing equivalent in housing. What we need now is a minister who says, I will reduce the cost of building a family home by X% in the next 2 years and live or die by that promise. But we don't have anyone. So it is a mess, but at least I think the central bank has taken a step in the right direction and said we're not going to solve this by giving people more credit. OK, let's go to someone at the coalface. James Nugent, you're MD of Lisney's. What do you think of today's measures?
I think in the first instance, if we've learnt anything over the past couple of years, it's that we need a proper functioning banking system. And actually this instrument is addressed at the banking system, albeit dealing with the property market. So in that sense, we'd welcome it. It's certainly not without its problems. You've heard people speak in the audience here, the difficulties they're going to have. And there's no doubt that first-time buyers are going to struggle to get together the requisite deposits. I also think there may be other knock-on effects that we just haven't thought about, and actually this may become a barrier which is going to price lower earning people out of the market. So it's by no means perfect. There's a consultation process which the central bank has to go through, and I think all the people who have vested interests, it's incumbent on them to put forward the problems with it so that we get it right.
I think there's a Miriam in the audience who thinks it's a good idea. Are you there, Miriam? Yeah? Yeah, what do you think?
Yeah, well, I actually had saved 30% deposit when I bought my house, even during the sort of boom times. And my thinking was that, well, that's kind of what I need. And I know when I went in to talk to my bank, they were almost laughing at me for having saved 30%. They're like, well, we have never seen this before. We've never sort of seen. But to me, it just seemed prudent, you know, that you would have a substantial deposit saved before you bought a place.
Did it take you a long time, though, to save?
Well, I was working as a teacher at the time, so not, you know, coming from an enormous financial background. And I suppose I just lived prudently and saved and put money away every week, and that's what I did. But I think, I mean, it did prevent me from... I'm not in negative equity now, and I suppose maybe I'm sounding a little bit smug, but to me, I suppose it just seemed like a kind of a sensible thing, so I do think it's a good idea.
You were mentioning as well, I'm going to ask you both, you know, that 3 months seems to be a short time to bring it in. I mean, could chaos now follow? I mean, people are going to be thinking tonight, jeepers, should we buy now? Should we wait till January? And will it cause a bit of chaos in the housing market? So, I mean, the initial reaction is, as a first-time buyer, I don't have the deposit to afford the prices at the moment. But part of this is designed to bring prices down. It's to get housing more affordable. Now, it can't do it on its own. We need more supply. But certainly by taking out the credit fuel, you should bring prices down back to what does match with people's incomes. So that would be the key thing there. But I do think we're going to have
probably a wild 6 months, with some people rushing to get in by the end of the year if they've got particular mortgages offered, and other people waiting. We could have a pretty quiet first 3 months.
What do you think,
I think, you know, the boom to date has occurred almost in the absence of credit. So you can't go blaming credit for what has occurred so far. It is strictly about shortages of supply. You're going to lock out 2 and 3 first-time buyers and basically send them off to pay higher rents in a high taxation environment, and eventually probably pay a higher price for a house as well. And the consultation process, you know, coming in on the 1st of January, and the legislation is apparently already drafted up. This is a consultation and everything except for spirit and practice.
OK, well, listen, Cardi, to your own lines, and everybody who's spoken in the audience, thanks so much. David.
This day week we'll be discussing the details of next year's budget due to be outlined in the Dáil by Michael Noonan and Brendan Howlin.